Siam here, and in this video I am going to rant furiously about fund managers because they are nearly all shit. Okay, so this is a topic which has really pissed me off for a long time, and I've made a lot of videos about why you can do... Oh my god, my hair. I haven't really looked at the mirror today. For a long time I've always said that you, as an individual person, an average Joe on the street, let's say, can do a lot better with your own money than the average fund manager. Now, just so you know, there are two types of funds out there. You have active funds and passive funds. I'm being pretty broad brush here. So an active fund is where you're putting your money into some sort of fund, and the fund managers actively placing trades, investing into things, and getting in and out of different stuff. And a passive one is where you put your money into a fund, and that fund is simply linked to some sort of tracker. So it's like a tracker fund. So what it tries to do is beat the average stock market. So it'll try and beat the FTSE or the S&P 500. And so typically what happens is that, let's say the S&P 500 does well, your tracker fund will do slightly better. So basically a lot of fund managers, they'll lose their job if they don't beat the stock market. And let's say, I don't know, the S&P 500 goes up 10% in 1 year and your fund goes up 12%, they'll actually celebrate. They'll celebrate that they're charging you shitloads of money for something which, and they only beat the market by 2%, which is just rubbish. Sorry, Coco's just joined us. So yeah, and what you'll find is that a lot of these funds, they can't actually get out of Dodge when you really need to get out of Dodge. So, because part of their bylaws and policies is that, you know, at all times a certain percentage of the fund must be linked to the stock market or bonds or whatever. And at the moment we're having a massive shitstorm in the markets, where you really need to get out of bonds and stocks like a freaking sap. I mean, even these all-weather portfolio funds where they say, oh, it's got a we got some fancy software, and if the markets, start falling, it'll get out of that, blah blah blah. Well, here is a screenshot of one of these sort of all-weather portfolio ones, and look what's happened. It dropped 10%, and then even with the rebound, it's still massively down. And so the people that have been in that fund, they've just lost their money, even though the stock market has rallied ridiculously. So what I'm going to do is two things. In this video I'm going to make it long, and so I'm going to cut two things in. So the first thing I'm going to put in is why you really need to get the hell out of anything stock market related right now. The second thing, which will end the video, is just a little animated video I made, which is 11 reasons why you can do better than your fund manager. So just before we do the first cutaway thing, if you're the reason I say you need to get out, so a lot of the reasons why fund managers are telling everyone right now, don't panic, don't lose your head, now is the worst time to pull out, blah blah blah, stay put, it's because they're worried about their own money, they're worried about their fees. Because if everyone starts pulling out of their funds, guess what? They lose loads of money, and it's a bit like a bank. A bank does not want a bank run. They don't want people extracting all of their the funds from their accounts, etc. So, and you need to understand how a fund manager makes their money. They make a tiny percentage. It's called an expense ratio. So they'll make, I don't know, 1% a year for however much money is in whatever the AUM is, assets under management, etc. I mean, it depends what fund you're in. A long time ago it used to be 2 and 20, so they used to charge 2% a year and then 20% performance fee. That doesn't really happen so much these days now that we have all these big trackers. But long story short, they make their money from commissions from going in and out of stuff, but mainly it's a tiny percentage. So if they've got, a couple of $1 billion or pounds in a fund and then making, I don't know, 0.5% a year on that, that's a good business. And so if everyone starts running away, they're losing money. So that's the main reason I fall out with a lot of fund managers, because they just become dicks and they do the wrong thing for their clients. So really, when we're having these crashes like we are right now, we've had the big drop. We had like a 38% drop in like no time at all. And now we've had that relief rally, which a few weeks ago I said, you know, we're going to have a massive relief rally or a stimulus pump. That's happened. We've had a 50% retrace, if not more. No, we've probably had about a 55% retrace now. So now is the best freaking time to get out, because we are in for the worst economic shitstorm ever. And for those that are thinking that I'm just saying this just because I've got, you know, I'm trying to short the market, etc. It's bollocks. Yes, I am trying to short the market, but even if 1 million people exited their funds or whatever, it would make no difference. I trade the currency markets. I don't trade the stock market, and the way that I trade doesn't even affect real life prices. So, yeah. So, like, it makes no difference whether you protect your own money or not. All I'm saying is that right now it's highly probable that we're going to have one of the worst economic depressions in history, and we're going to take out those lows. I would not be surprised if we saw a 70 to 80% collapse from top of drop. And so if you're in anything index related, you need to just get out. You need to get out now, and then wait, and then buy in later. So go to cash. So here's a video which explains why, and then after that we'll just cut straight to that animation. I hope this makes sense. And yeah, if you do have anything stock or bond related, just get the hell out. Honestly, just hopefully this video is going to prod you enough to do your own research into this. So yeah, toodles. So this is for those of you who are not traders, you don't want to learn how to trade, but you've got investments, maybe a workplace pension, you've got ISAs, I don't know, it's just some sort of like savings or whatever. And right now, let's say pre-crash, you had, I don't know, 100 chicken nuggets, whatever unit of, you know, your thing is. You had 100 chicken nuggets and they're priced at £100 each, whatever your thing is. So at this point over here, your nuggets are worth 10 grand, okay? So this is your life savings, you've got 10 grand because you've got 100 nuggets, 100 units or whatever it is. So what's happened is that the market has just done this, okay? And so now the price, let's just say, is hovering around £39, okay? So what this means is that your 100 nuggets, all of a sudden, as of today, is worth £3,900. So everyone is going, oh shit, I'm massively underwater now because of this. This is where everyone is going, like all your friends and family are saying, oh no, just wait it out, it'll be fine. If you sell your stocks now, you're just crystallizing your losses. Just wait until it gets back to all-time highs again, and then you'll be fine. I'm in this for the long run. I cannot stress how dangerous that thinking that is. So this is what you could do. I mean, yes, you could probably try and wait for a stimulus pump. Hell, yeah, maybe try and do that. So eventually, something will happen where we'll see something like this. It'll probably only go back to, I don't know, 50, 60. Let's just say you time it badly. I don't know, at this level here, 50. What I would do is I'd wait for the stimulus pump, that relief rally I mentioned earlier, and then I would sell here, okay? I would literally sell every equity exposure you have there, and then go to cash. I would literally, so you literally exit, you've basically crystallized half of your money, so your 100 nuggets is now only worth 5 grand. But here's the nub, okay? So this is not to scale, by the way. I'm going to accelerate time over here. So let's say by this point here is in, I don't know, let's just say 12 months time. So 12 months from now, or 12 months from top of drop, this is most likely going to happen. So we'll probably see, I don't know, the price be something like, I don't know, let's say £20. So all you do is you take your 5 grand. Where's my calculator? I'm not good at maths, so I may as well share with you, hopefully. So you've got 5 grand in cash that you've been sat on. And then you let's say you're obsessed with this stock for some reason, and you want to basically get back into this stock. So you take your 5 grand and you buy as many of this stock as you can near the lows in about 12 months time, 18 months time, and at 20. So 5,000 divided by 20, you've now got 250 chicken nuggets or units of your stock. So now you go back in, you've got 250 nuggets. So this is basically 250% more nuggets than you had to begin with. And then, let's just say, over time, then you can play the long game. Like, yes, there's nothing wrong with playing the long game as long as you do the long game properly. Most people are not playing the long game properly. They're just sitting and waiting and basically letting the avalanche take them out. And then eventually this will happen over time. I know this could be over a 5-10 year period, but eventually, yeah, we're gonna get back to all-time highs or back to post-crash highs. And all of a sudden, your 250 nuggets at £100 up here is now worth £25,000. That is how you play the long game. I cannot emphasize that enough. It's simply startling how many people bust their guts at work for however many decades to slowly build up their nest egg, and we're all too willing to hand over the reins of our money to a fund or an IFA recommending and allocating our money into a fund. But the stark reality here is that 90% of fund managers don't beat the stock market. It's ridiculous. This is why I really don't care if someone has an alphabet of letters after their name. If I was forced to hand over my money to someone, I'd much rather give it to a trader than a fund manager. In this industry, you typically have 2 types of fund, alpha and beta. Alpha funds are active and they move you in and out of assets. Fees are high, and it's this type of fund which rarely beats the market. Beta is a passive fund where you just sit and plod along in some sort of tracker and is a lot cheaper, fee-wise. It's also really crappy how the banks dupe people into certain actively managed funds. What they may do is set up 20 different funds at the same time and give a small pot of money to 20 different potential hotshot money managers, and then see how they do for 5 years. 5 years later, 90% of them will have failed miserably, but the 2 that did well will then be applauded and publicised to the general public for investment. They will then show the 5-year track record and extrapolate one's potential rewards. But statistically, even these then proceed to falter. So the whole point of this video is to basically show you why you really don't need a fund manager, and that you are potentially the best money manager you will ever need, provided you invest in your own knowledge, that is. So here are the 11 reasons why you can do better. 1. You have no conflict of interest. This is a biggie. You are the only person who cares the most about your money. The amount of conflict of interest in this field is shocking. From advisors that get a kickback from providers they refer to ensuring the longevity of their job and company. You see, the funds focus on increasing their AUM, assets under management, because the more money they manage, the more fees they make. So they will organise and run the fund in a way that doesn't rock the boat. Also, the fund manager is always at fear of losing his or her job, so he or she will toe the party line. Also, if your fund is affiliated in any way to a bank, it will no doubt be offering bank products, whether they are good or not. In most cases, they are utter shite. 2. You have no career risk or peer pressure. Basically, you have full control and won't be affected by peer pressure. What it means in this sense is that if the overall market is bullish on a particular asset or industry, but your fund manager isn't, well, tough. In most cases, your manager will leave his or her spine at the door and play sheep, and also invest in that asset or industry. Safety in crowds, you see. If that asset tanks, no one will care. Everyone will keep their jobs because everyone got it wrong. But if everyone invested in an asset which hit the moon and you're the only fund that didn't, your manager would lose his or her job, or the fund would just bleed capital outflows. 3. You can invest in anything, anywhere. If you are managing your own money, you aren't stuck to just one asset or industry. If you wanted to invest in an exotic asset or even cryptocurrencies, you could. Most funds can't, as they have to stay within their licensed investment area and regulations. 4. You can be fully invested or fully in cash. Believe it or not, there are many funds out there that have to be in the market, even if they think the market is going to crash. There is an aversion to getting fully out and sat in cash because you'd then be paying a fund to just hold your cash, which they can't do. Well, you as a private investor aren't tied to any rubbish like that. You can be fully in or fully out as you wish. 5. You can concentrate capital into assets. Funds will have a minimum and maximum amount of your capital they can apply to a particular asset, so they can't go all in on something. However, as a great trader once said, you have to know when to be a pig. So as a private investor, you can. For instance, it's 2018 and it's blindingly obvious to me that the crypto world is about to explode, very much like the internet did. It's literally the evolution of money and presents one of the best investment opportunities in human history. So me, as an individual, can be a pig in this market, whereas pretty much every fund out there isn't allowed or doesn't want to for fear of career risk and also regulatory lashback. 6. You have no ridiculous benchmark to set. As an investor, you should only care about the net ROI of your money. So losing money in any type of market is not good. However, I've seen with my own eyes fund managers congratulating each other that their fund was only 5 or 10% down for the year, when the whole market was down, say, 20%. They use the main stock market indices as benchmarks, you see. Surely, if you're paying someone a whole bunch of fees for the best investment advice out there, you would hope they could at least forecast an impending crash and profit from it instead of shuffling around deck chairs on the Titanic like every other fund manager does in times of capitulation. 7. You control the costs. Some funds are just downright extortionate, and because some funds have kickbacks with the products they go in and out of, they can sometimes churn your fees. They will place excessive trades just to get more kickbacks. 8. You can easily buy and sell in any size. This is because you no doubt have an insignificantly small investment pot compared to a fund. So you're able to dance in and out of the market cheaply and quickly. Whereas if your fund wanted to buy $1 billion of Apple stock, it's a bit trickier. 9. You won't succumb to bad computer decisions. Although AI and AI trading algorithms are good, they are not infallible yet, and often make mistakes, and can't yet properly read or understand overall market sentiment. This won't be a problem for the average investor. 10. You will learn from the bad years. Let's say you put your money into a fund and there's another 2008 style crash, and most people lose money. Well, all you'll get is just a balance statement showing how much money you've lost, and that's it. Whereas when you're managing your own money and you lose, you frickin' learn. Thus, you'll be enhancing your investing skills and ability for the future. Despite my personal trading achievements and windfall trades now and again, I'm nothing special. I'm simply a product of over 13 years of hard and painful mistakes. Learning from your mistakes is so important. 11. You can play the long game. Believe it or not, the average fund will only have you in a particular asset for an average of 11 months. There's this extremely short-term thinking, which then eliminates any chance of you riding out a crazy bull market. Or if you're in an asset which is down for a bit, but you know it will recover, you don't need to sell out. You can simply wait. So they are the 11 reasons why you don't need anyone but yourself in control of your own money, and hope it helps. Just have these points in the back of your head the next time someone tries to lure you into some shitty mutual fund.